Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest costs, and who doesn't like that, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. The debt ceiling debate is making headlines, but there's another important ceiling that's capturing the bond market's attention. However, that doesn't mean we can ignore the implications of the debt ceiling on the housing and mortgage markets. The debt ceiling debate affects market sentiment, creating fluctuations in risk appetite. If the issue is resolved smoothly, investors may show more interest in buying stocks and selling bonds, which leads to upward pressure on interest rates. This week, we saw a general trend of rising rates, with the 10-year Treasury yield serving as a reliable indicator. While there were discussions about the debt ceiling, there wasn't strong evidence that traders were anxiously reacting to political drama. The possibility of a U.S. debt default causing market turmoil is highly unlikely, but possible. Let's delve into the impact of the debt ceiling on the housing and mortgage markets and understand why or how it fits into the broader financial landscape. This week, the focus of the markets shifted towards the Federal Reserve and the economic outlook, drawing much more attention. The tone for the week was set by the retail sales data released on Tuesday morning. Traders were particularly interested in the various speeches given by Fed officials as they consistently emphasized that the battle against inflation is far from over. They made it clear that the future rate hikes will be data dependent. Now, interestingly, at the beginning of the month after the previous Fed meeting, market participants had largely discounted the possibility of additional rate hikes. However, by the end of this week, the chances of another hike in June have increased to nearly 50%. The rate outlook, which was initially at 5%, has now moved up to 5.11%, indicating about half of a 0.25% rate hike. It's clear that the market is closely monitoring the Fed's actions and economic indicators to gauge the future trajectory of interest rates. The Fed's comments and economic data had a significant influence on our expectations for longer-term interest rates. Let me explain how the market perceives the outcome of the December Fed meeting. The economic data is presenting a mixed picture. While some may interpret it as a sign of trouble for the economy, I see resilience in several areas. Take retail sales, for example. Although the month-over-month performance may seem underwhelming, it has actually held up better than anticipated, considering its significant deviation from the trend. I noticed more evidence pointing to the economy's challenges, particularly in the rate-sensitive sectors such as housing. Unfortunately, this week's existing home sales figures didn't provide much reason for optimism. It's important to keep in mind that the scarcity of available inventory in the housing market is not just a talking point used by housing market enthusiasts. It is a genuine factor that is affecting sales figures. Now, interestingly, it also serves as evidence that the current market conditions in 2023 are vastly different from those experienced in 2008. The new home market has shown some improvements as builders are not relying on homeowners deciding to sell or refinance before putting new units on the market. Construction figures indicate a moderate adjustment from peak levels, but they remain consistent with the trend seen before the COVID-19 pandemic. Builders were feeling down about the spike in interest rates in 2022, but there's good news on the horizon. The latest NAHB index, which measures builder confidence, showed a positive shift in their outlook. The index increased from 45 to 50, surpassing the predicted medium forecast of 44 and indicating a notable improvement in sentiment among builders. The economy's strength and the Fed's reminders about interest rate projections coincided with a crucial moment in the bond market. We found ourselves running out of space within the existing range. And as a result, we witnessed a breakout, most notably observed in 10-year Treasury yields surpassing the 3.6%. And just to emphasize, once again, the 10-year yield serves as a reliable benchmark for mortgage rates. In line with the breakout in the bond market, mortgage rates also experienced a significant upward movement. These breakouts indicate the market is aware of the possibility that it may not be the right time for a major reversal toward lower rates. However, the positive aspect is that the market is also not convinced that rates need to surpass the levels seen earlier this year or in late 2021. Although we may be breaking out of the narrower, more recent range, there is still a longer-term consolidation pattern that remains solid. This ongoing debate is something we anticipate will take weeks or even months to resolve. In the meantime, it's important to note that the volatility can occur within these ranges. We can expect ups and downs driven by data releases and events. Looking ahead to next week, two key events to watch out for are the PCE inflation data on Friday and a series of important speeches from the Fed throughout the week. These events will likely have a significant impact on market movements and sentiment. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching. And if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.